Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. HRAA could provide balance to your portfolio by harnessing 3 unique investment styles. The first is an actively managed global risk parity portfolio to provide maximally diversified global exposure in optimal risk balance. The second is a proprietary systematic global macro process that attempts to profit from short-term market moves, going both long and short on more than 50 global markets. Finally, HRAA uses a dynamic tail protection overlay that attempts to profit from large moves in volatility markets. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.
Okay.
Well, that was an experiment.
That was a lot longer than I thought.
It's compliance, baby. Not much you can do.
Wow. Okay.
Let me apologize. Hopefully,
do we have any time left to chat?
Apologize for nothing.
Dial in late. Sorry about that, everybody. We'll work on that.
Don't apologize. Don't apologize. It's got nothing to do with you.
I'm Canadian. Well, ladies and gentlemen, please welcome to the stage Mr. Brian Moriarty.
Put your hands together.
I will also remind everyone that if you're looking for investment advice, this isn't the place to get it. You should consult a licensed regulated individual in your area, but we will have wide-ranging conversations here and we'll have a lot of fun. And we do have Brian Moriarty from Morningstar here with us today. Very excited about this conversation. Before we have Brian introduce himself, I am having a lovely Armagnac today. I don't know about you gentlemen. Cheers.
I got a little white wine, a little Casillero del Diablo.
Mm-hmm. I have to be the starter at a swim meet in an hour, so I hear it's frowned upon to be drinking in advance of officiating. But you know, next time I'll try to push that limit and see what they say.
It's understandable. What do you got, B?
I have a sparkling water because it's still on the clock, and I have a 2-year-old, so I need to be sharp.
Always on the clock, then.
We'll never report you to
I don't even know what that means.
Yeah. Nobody watches this show, so it's really not even happening.
Right. I want to have a talk about, in our opening compliance monologue, we talk about consulting with regulated professionals in your area. And, I don't know about you guys, but I constantly get requests for people to review portfolios that were put together by qualified regulated advisors in people's areas. And man, if 1 in 100 are thoughtful, reasonable portfolios that address somebody's unique objectives and situation, then that would be an exaggeration. What are your thoughts on that? Honestly, is the idea of being regulated advisor in somebody's jurisdiction a reasonable qualification? Can we not give people better guidance on the type of people that they might seek out to help provide advisory services on their funds?
Sure. Well, let's do a show on that. But rather than stealing Brian's thunder,
fine.
I want to know about who Brian is, besides my dungeon master.
Yeah. That's taken up 2-3 hours a week for the last year. That adds up. So I've been with Morningstar since January of 2013, so it'll be my 8-year anniversary coming up in almost exactly a month. And then with the manager research team since September of 2015, which has encompassed a lot of pretty interesting markets. Loved every minute of it. So I did not intend to, when I graduated from college, to join the financial industry. I wanted to work in government or public service or something like that. So we can always talk about that if you guys want to, but ended up here and loved every minute of it since then.
That's amazing. And so what do you do at Morningstar?
Sure.
What's
So
your job?
I'm a associate director of the fixed income manager research team, which is there's about 12 of us. I have 6 analysts that I am overseeing along with my own coverage list. And so we do manager research. We're talking to portfolio managers. We write the Morningstar analyst rating. That's that gold, silver, bronze, neutral, negative rating you see out on funds. We don't have anything to do with the star rating, although that is a component of what we're looking at. Yeah, interview portfolio managers, write the report, spend a lot of time looking at portfolios and really trying to understand, how the sausage is made, so to speak, and if managers are doing a good job or not.
How has that process changed over the years, Brian? I mean, I don't know if you were exposed to, what things were like 3 years ago, 5 years ago, 10 years ago, but I would imagine that a firm like Morningstar learns from feedback from the process. So what have you guys learned over the years on this?
Yeah, absolutely. So at the beginning, manager research is, I think, technically Morningstar's second line of business. The first was packaging mutual fund data, which at the time when Morningstar was started in the 80s, you couldn't get consolidated fund data anywhere else. After that came the research side of it, but at the beginning it was very short, like 2 to 3 paragraphs, like can fit on a third of a page. The Morningstar, what kind of one-page report is what they were known for. We were known for at the time, and that was manager research at Morningstar for a long time, was this shorter report. And then in the 2000s, in the early to mid 2000s, we expanded that into what we now know as Morningstar Manager Research, which is a much more robust report that does a deep dive on different pillars, right? The sort of 4 or 5 Ps. We're currently down to 3 Ps that we are rating: people, process, and parent. We no longer rate performance and price, which, if we're talking about evolutions, that's the big one that came out recently. Is that last year we switched to this new methodology, which we cut out an analyst no longer rates price and performance. Those are automated to a degree. And what we're trying to signal with our ratings on people, process, and parent is, are they going to be able to capture alpha that's available in a specific category? And so the higher the ratings on those 3 pillars that I mentioned before, what we're saying is that they are more likely, this manager is more likely to capture the alpha available in any given category, and it changes obviously from category to category.
So that sounds more qualitative, right? So what are some of the inputs to those qualitative models that you guys consult as you're trying to draw conclusions in those 3 Ps?
So we do, at the start at least, it's kind of basic what people would expect from manager research, meaning we are interviewing the portfolio managers, we're talking to the support staff, the analysts, we're collecting data from the managers. But that is a much smaller piece, at least in my experience, in my perspective. The relationship that we have with the portfolio manager is much less. It's reduced compared to maybe manager research that's done at an endowment or a pension or something like that. Obviously, a big reason is that we don't have capital that we're putting to work, or like those firms. But we do those, have those interviews, and then after that, it's ripping apart the portfolio to understand, all right, this is what the manager told me. So did they perform the way they would have expected, the way they explained it? How does that match up with the portfolio? Are there inconsistencies between the two, right? A lot of time a manager will say, especially in fixed income and credit, oh, we don't take a lot of risk, and we're trying to be defensive or whatever. And then you look at the fund's yield, or they've got mezz structured products or whole business loans or something like that does not match up at all. And so we're trying to understand the what's in the portfolio and what are the expected performance patterns, knowing what we know about the portfolio. And that's really, I mean, we obviously look at number of analysts, manager tenure, manager investment, all that stuff, which is all components of our ratings. But those are not, like, I'm not going to say they've got 30 years experience and 40 analysts, like that's a good people score. Could be a good people score, but we're not just that superficial, right? It's what's the analyst experience in mezz credit or whatever, right? Are they churning through people 2 to 3 years and then they're out and gone? Like, what's going on underneath the hood? We don't really care for, or I should say, those headline numbers that are cited often are not, that's the starting point. That's not what we care about at the end of the day.
So how do firms use this research? Typically, if you've got an institution or an advisory practice, how should they look at the research that you guys produce and drill into the most salient characteristics of your reports?
Yeah. So we're writing it. Our goal is to help investors make better decisions and to choose between this massive offering that they have available to them, right? The investment universe, it's been getting smaller, but it's still really massive. And if you just go by, headline numbers or returns or the marketing materials that a fund manager is putting out, it can be hard to differentiate, right? Or you look at funds that have, two different total return bond funds might perform similarly, and then they end up having wildly different, underlying holdings, and the reasons they perform similarly are completely different. So our reports are meant to highlight those specific points, what's going on in the portfolio, how a fund is expected to perform in different markets, so that investors have a much better sense of what they're buying. So you're not going to find, sometimes we might have in our reports, the whole process or portfolio section might be dedicated to one or two trades or to something specific that happened that highlights bigger picture what's going on. So we are not, it's not a checklist report. We're not trying to tell an investor everything about every fund, but what are the most important points, what's going on, what were the big drivers of performance in certain periods. For example, March of this year was the big one that we really spent a lot of time understanding and why things happen the way they did, but it's not, like I said, it's not a checklist. It's not descriptive at all. This is our opinion focused on the specific, most important items that we think investors should be aware of for any given strategy.
So credit has always, I've always sort of decomposed it as long rates and short a put, and depending on the grade of the credit, short a put that's out of the money, but the out of the moneyness is a function of the quality and size of the equity tranche that buffers the risk to the credit holders, right? Is there an explicit model internally that you guys use that sort of says it's mezz debt or it's triple C or it's double B minus or what have you, and then are able to price that as an option and sort of relate it to some kind of OIS spreads or historical OIS spreads on that credit grade relative to treasuries or something like what kind of models do you guys bring to bear on credit? It's always been a mystery to me how to analyze it.
It's difficult, and there's no good answer to that. So we don't have one sort of master model that we're plugging this stuff into. What we do instead is collect as much historical data as we can on different tranches and sectors and slices of the market, and then look at performance at different time periods. So for example, like an easy one, I'll kind of back up to just talk about what I mean, is that an easy trap for a newer analyst to fall into is a fund, let's say it's the period of 2016 to the third quarter of 2018, right? Let's say for fixed income, that was an extremely bullish period. They look at a fund for that period and volatility is really low, yield is really high, Sharpe ratio looks beautiful. They're going to say, well, this is great. And I'm going to look at that and say, there's a problem, like there's a red flag in there. It shouldn't look this good to have a Sharpe ratio that high. It means they're taking on, let's say, something that is less traded or thinly traded, paying off a high coupon, which gets returned or it gets backed into the Sharpe ratio, and suddenly you've got this beautiful looking investment that is actually carrying a lot of hidden risk or risk that is not necessarily volatility, but it's gap down risk or something like that that's going to show up in a huge sell-off, for example, in March or even the fourth quarter of 18 to a certain degree, but much more so in March. And so what we're doing is looking at different sectors and slices and tranches, right? So for example, CLOs, the rating spectrum for CLOs or for CRTs, credit risk transfers, something like that, and saying, all right, what's the standard deviation, the vol of these things, what's the coupon, what's the actual drawdown loss, and then we use those pieces to try to build an understanding of how a portfolio might perform. And because something might be a small thin slice of a portfolio and end up being 90% of driving their performance up or down markets, just because the skew, so to speak, on these things can be massive in certain environments and disappear entirely in other environments.
So I'm going to throw Corey under the bus since he threw it out there, but he's wondering what happened to IOFIX in March.
Yeah.
And I think it's a good case study, anyways, that we can kind of dig into what the value of digging a little deeper, the way that the qualitative team at Morningstar does, and how that might be able to add value.
Absolutely, yeah. So that was one pretty well known, I think. It blew up spectacularly in March. The fall was almost a straight line down on its growth of 10,000 chart to a massive degree. And what was going on there is, before that, if you cut off the March period and just looked at it since inception through 2019, it was just a perfect step up line in its growth of 10,000 chart, and it effectively, the returns looked like they were autocorrelating with themselves, right? And what was going on there is that portfolio held, at the beginning, it owned a lot of odd lot sub non-agency mortgages, either junk or not rated odd lots that they were buying at the beginning, because then you can buy odd lots and then you can round them up or mark them up to the round lot position. And they were buying stuff that even other sort of legacy large non-agency investors, whether it's PIMCO or TCW, Double Line, and so on, those investors were not buying the stuff that IOFIX was buying. And so you ended up having this beautiful return chart. But then in March, when liquidity disappeared completely, those positions and they started to get outflows, they had to mark everything down to an extreme that I haven't really seen, maybe in one or two other cases. Over time, they had also added a number of credit risk transfers, or CRTs, which are issued by Fannie and Freddie. These are effectively mortgage credit beta, issued by Fannie and Freddie, that had never really been tested in a downturn. And so there was an over the weekend, they were trying to unload as much as they could to meet redemptions, and they ended up selling most of their CRT position because that was the more liquid of the two components of the portfolio. And then they managed to survive through Monday, and then that same week, I believe on Tuesday was March 23rd or 24th, the bottom, and then they survived after the Fed stepped in. But it's one where, if you had looked at the returns of this portfolio, this looks amazing. There's no risk here. There's no volatility. I'll put it that way. There's no volatility, and then the risk realized, and investors booked massive, extreme losses.
Is that similar to the bank loan side of things?
That is riskier than the bank loan, or at least the realized risk has been more extreme in this sort of RMBS mezz mortgage credit part of the market. The bank loan market is closer to between IG and high yield corporate credit, and so it's not going to. I wouldn't expect to see the same level of drawdowns there. The risk to the bank loan market is that rates stay low for so long, and that investors just sort of bleed out. But I view the two as they're pretty similar in terms of liquidity risk, right? Given that bank loans are not technically securities, they don't their liquidity is challenged, especially in stressful markets. But what happened to IOFIX was a really specific thing that we are constantly on the lookout for. We've noticed it. The things that led to that fall, any fund that saw massive losses in that period was most likely overexposed to mortgage credit risk in different flavors. And that's really, especially kind of the mezz structured stuff, it's always where people where you can hide risk for bull markets, and then the revealed in bear markets, especially liquidity challenged markets.
This is what always really I struggle with in credit, where credit, it's really easy. There's a lot of innovation in credit markets, right? Think sort of CLOs and
Yep.
all manner of structured and substructured type of issuance. And so every time they create a new structure, there's no history previous to when they create it. And because of that, you could go many months and in many cases many years without being able to observe the true risk character of the structure, right? Because the option that you've sold is very far out of the money on a condition that we haven't seen before, right? Or we haven't seen recently, or is unlikely to present itself. And so, I mean, we don't trade credit for that reason, because we feel like we can't empirically measure the risk in any way. I mean, we certainly would acknowledge that for many markets, the biggest risk that we take is the one that's ahead of us, right? And so the largest drawdown is ahead of us, and there's always risks that have not manifested yet that we need to be prepared for, right? But in credit, because of the number of different types of structures and the constant, again, innovation in the space, you constantly have these structures or these types of credit with very short histories. And it's very easy for investors to get into trouble by just not knowing the underlying risk that they're facing. We see this in Canada. We've seen this, that these offerings to retail investors for years. I mean, Mike, you go back 25 years dealing with individual investors in Canada, and you've got these private credit funds that for 10 years never have a down month and seem like free money to uneducated Canadian investors or inexperienced Canadian investors and advisors. And out of the blue, there's an event, and now they're gated, and now there's some sort of credit waterfall that everyone's got to wait 18 months for everything to go through, and you can't get your money back, and you have no idea how much money you're going to get back. How do you, as an analyst, step into that swamp and navigate it and sort of put your name on the risk metrics that you're going to put out there to help people be made aware of? It all seems like very nebulous and very hard to kind of wrap your head around and quantify.
It is. And that's one of the reasons why we, to back to your other question, why we don't have explicit inputs into a model of some sort like that, just because in a lot of cases, we know based on a historical experience that even if we had a number to plug in, we wouldn't be comfortable with that number. It wouldn't be right in a realized sense. And so it's hard, frankly, and that's why we spend a lot of our time understanding. So for example, with CRTs, because that's a more recent example, and I can use this as a case study for how we would think about it, is that CRTs were created in 2013 specifically to move the mortgage credit risk on Fannie and Freddie's books off to the individual investor, or to investors, whoever they may be. And at a high level, that sounds great, right? In the sense that if I am a taxpayer, or I'm somebody in the government, I don't want to pay for Fannie and Freddie's mistakes ever again. So I'm going to move this risk off of their books and into the investors' books. The problem with that, from the investor perspective, right, putting my investor hat on now, is that a lot of things. First of all, the tranches on CRTs were extremely thin. So 50 basis points, 70 basis points, 150, and so on. So you only need, let's say, 50 or 100 basis points of losses before that tranche is gone. It's wiped out. That's nothing, right? In any sort of extended market, any sort of extended bear market. And at the same time, you're thinking about things where, okay, Fannie and Freddie is selling this risk off of their books to me or the buyers. Don't you think Fannie or Freddie knows more about what's going on in that book than whoever they're selling it to, and the pool of mortgages? And also, what they're selling, this risk transfer item security, is not actually, it's a reference note to this pool of mortgages. You don't actually get any ownership of the pool of mortgages, so there's no collateral underneath it except the GSE's promise to pay. And so when you sort of run down the list of all of those features, right, we don't know how it's going to perform necessarily. We don't have any data to plug into it, but you look at all that and you're like, okay, this is eventually going to be a problem, right? And we don't know when or how. And that's just how anything new like that, that's
And
what we do. Yeah.
every investor enters into a purchase agreement with asymmetric negative information, right? Like Fannie and Freddie always have an edge.
Yep.
They know exactly what the underlying are. They've got hundreds of thousands of data points and of portfolios with similar underlying that they can use for pricing at their end. And the public markets have none of that information or much less of it and are therefore at a major disadvantage. So does the public market participant, what sort of premium do they price these at in order to overcome this major information asymmetry? Or how should we think about that?
It's come down a lot. So in 2013 and 14, when they were new, the premiums were huge, and people who were buying them then ended up making a ton of money. Since then, they've come down to next to nothing because now demand is huge. People want mortgage risk, right? So if you put this period into context, at the same time as this is going on, a lot of fixed income investors were in love with consumer, right? Like the corporate balance sheets were, consumer balance sheets were just getting better and better. So over this period, more and more fixed income portfolio managers wanted exposure to the US consumer. Best way to do that is mortgage credit. And so demand was increasing at the same time as this was going on. And so they just kept pricing it tighter and tighter and tighter and tighter until it became, in a lot of ways, uneconomic to buy these things, but they were still being bought. And what happened is that people were convinced to buy these. I don't want to say this convinced is a loose term, but one of the things that everybody pointed to when they were buying these was that stress tests showed that they would have come through 2008 in flying colors, right? And that's true in the sense that the model stress test said this, but these didn't actually, right? This is a back test. These didn't exist in 2008. And
who writes the stress test? Is it Fannie and Freddie, or is it Morningstar?
No, we do not. It would be Fannie and Freddie along with any investors who have their own capabilities to do that, kind of pulling out the reference pools and plugging it in that way. Okay. So it's it's difficult. And what we saw happen is that these things ended up creating a pretty big bifurcation in investors where plenty of people were happy to buy these things for all the reasons that just listed, and other people were looking at these things kind of like we were, like something isn't right with that, and we're just going to kind of wait. So, yeah.
So what is an investor to do then? Is that the approach? There's there's something here that's not quite right. So let's pass. Because at the beginning, as you point out, there was, I guess, pretty significant premium to harvest or return.
There was, yeah. That's what we struggle with, and it's what our job is to differentiate or to identify. Okay, if you were, let's say, somebody was willing to buy that at launch and harvested that large premium. So, from our perspective, when we're looking at that in a portfolio, how much did they buy? Which tranche were they buying? So we're saying, okay, you're willing to take this risk. That's not a good or a bad thing on its own. But what was the decisions that went into taking on that risk, and how much capital are you putting at risk? Are you just kind of YOLOing it, or are you saying, you know what, if this goes bad, not going to lose a lot, but if it goes right, we're trying to, like, are they trying to find the asymmetric bet in this offering, whatever it is? And that's what we do. We apply that same framework to anything, right? So if somebody's buying CLOs or has been buying CLOs recently, to tie that back to a different market that's grown by leaps and bounds, are they buying triple B, double B CLOs that are the yield is huge, but they're going to become immediately illiquid in any sort of sell-off and cause huge problems? Or are they triple A, double A, single A, and so on, where you're getting a much better sort of risk reward offering regardless of the outcome, right? So we don't want to say don't take any risk, because then you'll never earn any return, but rather are you taking risk, I guess, safely and trying to pick your spots a little bit better?
Do we trust the rating agencies? I mean, they've obviously let us down in many prior crises. What has changed at the rating agencies to allow us to provide them with greater credibility?
That's a good question. I don't know if anything really has changed, at least not that I've seen, right? I mean, I think there's no good one for that. We use the credit rating agencies. We also use, we look at the yields for what it's worth on the buckets or on the ratings, right? So we're going to say, if a portfolio manager owns X amount of triple C, all right, what's the yield on their triple C bucket versus the yield on the market's triple C holdings, right? And try to, because even if the ratings are wrong, the market is going to be closer, and yield is going to be one way of seeing if that is, are they over or underexposed to risk in a particular rating bucket. I will say, though, that for what it's worth, AAA CLOs, there's never been a default in a AAA CLO. They've just been rock solid through every kind of market environment. So, which is impressive when you think about what a CDO did in 2008. So, we're careful in how we look at that, and we try to use sort of market measures of risk as much or more than just pure credit ratings.
For our audience, what is the difference between a CLO and a CMO?
Sure. The difference is the underlying. So in a CLO, collateralized loan obligation, those are bank loans that have been pooled together and securitized, mostly bank debt, leveraged loans. The bank loan Morningstar category is another example of funds that own these things. There are also commercial real estate CLOs or CRE CLOs, but those are less common. But the distinguishing characteristic is that both bank loans and CLOs pay a floating rate coupon. With a CMO or a CDO, the underlying in those cases were mortgages. But the structure, the pooled and securitized structure is the same that's been applied, everywhere and anywhere that it can be.
So why is it is it the CMOs and the CDOs defaulted because the Fed was not able to fire hose funds to individuals in 2008, the same way that the Fed was able to fire hose funds to corporations in more recent periods? So the collateral is secured by the Fed in a way that mortgages aren't? Or is that too simple?
I think that's a little bit too simple. I think what we saw with the CMO market in leading up to and into 2008 is that the collateral is just a lot worse than it's ever been anywhere before, from my understanding, right? So if you think about a mortgage, people can default, people can leave, right? Like you can just walk away from it. With a bank loan, if we're tying it back to the CLO example, bank loans are first lien debt. The corporation is a promise to pay. Like they're secured by something. These are all secured loans. So even though the structure, it's a three-letter word, the structure makes people nervous. The structure is the same. There are a lot of problems with the bank loan market now, where I wrote about during the summer. But the underlying is just, despite those concerns, the underlying in this case is just a lot stronger relative to what the underlying was in 2008. So obviously the Fed was a lot
secured in a way. Yeah, right. Okay.
Yeah. And obviously, the Fed is certainly has a component of that, right? Because they were so much quicker to act this time around. So I think we absolutely would have seen a lot more carnage in every kind of market if the Fed had not acted as quickly as they did.
So given the landscape that you just kind of laid out for us on the credit side of things, when we think about the 60-40 portfolio, right? This idea of having 60% of your assets in risk and equities and 40% in fixed income, I'm finding more and more that advisors, that 40% is less about safety and more of like a title of safety, when that it's credit that is very high risk because you need some yield. That to me ends up being less like a bond equity portfolio and more like an equity portfolio. What are your thoughts on how people should think about credit in that sleeve, or should it be its own sleeve with different types of risk ratings?
Yeah, I think you need to differentiate. An investor would need to differentiate between credit risk, which is effectively equity risk, right, or rate risk duration, which is going to hopefully act as a ballast or a countercyclical to credit and equity risk. And so I think it's easy to, buy the best performing core plus or multi-sector fund or so on, and without realizing that maybe that was the best performing fund of the last 10 or 15 years because its duration was underweight. It's got no duration or very little duration, and then it's just been massively overweight credit for the last 10 years, and that's why it's racked up such a good record. I think those strategies, especially in above average managers, can continue to do that and can continue to outperform. So I'm not going to paint a black and white picture, but I think you need to be aware of what those funds are offering you in terms of where are they getting their return from. And so if you truly want 40% of the portfolio to act as a countercyclical weight to the equity part of the portfolio, then treasuries and tips, right? And long duration assets, something like that, versus, all right, my portfolio is large enough to, let's say, absorb a certain amount of losses, or even it's okay if my fixed income part of my portfolio loses 3 or 4% this year. I'm okay with that because I know I'm going to catch the rebound the same way. Like, how are you, if that's okay, and that might be fine, right? But investors just need to know that's what a certain 60-40 portfolio is going to give them is, just muted equity risk, right? Or credit risk. Credit risk is equity risk light. So
what always was a mystery to me is, if you go back, and so there's two components to this, because one is sort of the benchmark or the indices of different credit sleeves, right? So AAA versus, investment grade versus high yield, et cetera. And so many papers have been written, and we've done similar research internally about the fact that higher yielding or lower grade credit, when you adjust for default and recovery, so default probabilities and recovery expectations, recovery realizations through history, taking more credit risk has not been rewarded on a risk-adjusted basis. In fact, our own research shows that it hasn't been rewarded on an absolute basis over a very long time horizon, right? So, in other words, investors would have been better off just investing in high-grade credit on a duration-adjusted basis after adjusting for defaults and recoveries than moving out the credit curve. Yeah. So that's one dimension of this. The other dimension is,
Adam, are you talking about that in the context of the entire portfolio or just in the bond side?
No, on the bond side. So on the fixed income side. Exactly.
Just want to contextualize.
Yeah, no, good point. But the other side of that is that the credit indices may not be reflective of the opportunity in the space, right? So, for example, Jake Economic constantly points out, and to be fair, I have not done research on this, and I'd love to hear your thoughts on this, but the fact that active management can play a higher value role on the credit side than on the equity side in terms of choosing better credits at different credit tranches. So notwithstanding the fact that it hasn't paid to take credit risk, is there a better opportunity for high quality managers to take advantage of credit risk on the fixed income side than we've observed on the equity side?
Yes. Yeah, absolutely. The answer to that is yes. So I would say that both of those things that you said are true, actually, right? So if you were to just look at the market returns of double B versus single B versus triple C, what you described in terms of not getting paid for taking on triple C or lower risk is accurate. That has been observed. I would agree with that. At the same time, we also have seen that it's been very possible for certain, let's say above average managers to find the opportunities within the triple C part of the market or single B, non-rated or what have you, to outperform even the sort of double B, call it benchmark, on absolute or risk adjusted returns. So there absolutely has been opportunity for that. I think part of that has to do with just the massive opportunity set relative to equities, right? So there's just more securities out there. There are more inefficiencies than the equity market. So all of the conditions that, let's say, were in place for equity managers to outperform 30 or 40 years ago, they have not gone away in the credit market.
That is hard to find. It's hard to contemplate. There's liquidity risks in waterfalls that are opportune. Someone has to get out of a portfolio because it happens to be a tranche lower than it was.
Yeah, yeah. There's all sorts of weird nuances and niches within this market that are still ripe for managers to outperform. Now, the corollary is also true in the sense that it's still ripe for managers to make a lot of mistakes and book massive underperformance. And so it's just an area where we've seen that active management there's still a wider range of outcomes, right? Which means good and bad. And so it's
More dispersion. But can
exactly.
they, with the spread so tight, I mean,
Yeah.
it gets hard. Any commentary there? I mean, it just seems so minuscule for the effort.
Yeah. Yeah, it's rough. As an example, are a lot of high yield managers that we cover actually this year, especially in March and April, actually started buying investment grade corporates instead, right? Because that offered a better risk adjusted return than the high yield market did. And so for managers who are able to do something like that versus, just an index or a beta play or something like that, it's strange to say that high yield managers who bought investment grade outperformed other high yield managers who didn't, right? But that's kind of what happened in some cases. I think the problem is that it gets to a certain point where you're just not getting paid to take the risk for spreads, right? So I think high yield spreads right now are 430 or so, and at least the yield on the high yield category is 430 basis points plus or minus. Back out 2% for inflation. It's just not. At that point, what we really start to pay attention to is: are they bottom feeding? Are they going to stuff that end up not going to get paid, or are they just telling their investors, "Hey, look, this is it. Right? Like we can't do any better," and that needs to be said. Frankly, which is one of the things that we've been trying to do recently, is that outside of bottom feeding credit or going way long duration, it's just there's nothing good out there, and you just kind of have to accept it.
So we're at 5,000-year lows in interest rate. So that's a bit of a headline. And we have, so maybe just shifting gears just a touch, how might we think about, in staying in the bond complex though, how might we think about hedging the bond portfolio to inflation? Beyond, not in a portfolio context, but just in the fixed income context, how might someone approach it that way? And so, well, actually, TIPS is one way. Certainly hedges an explicit sort of CPI type of inflation. Anything else out there that investors can sort of use inside their portfolio if inflation is a concern for their 40?
Yeah, inflation is a bond investor's nightmare, frankly. And the same way you would overcome the low yields is just more risk, higher yields. Like if you are confident that your high yield will last longer than inflation does, right? Like you're making an explicit sort of timing bet on the duration of inflation versus the duration of your asset, your higher yielding asset. That people are going to do that. That's not something we would recommend. I think in the fixed income world, TIPS is really the only way outside of credit and taking on a higher yield to outpace or try to outrun inflation, which
Convertible debentures from oil and gas and gold mining companies?
No, that's where I was going to go, right? Because I remember back in 2018, there was such a hubbub about the fact that such a huge proportion of the high yield market was related to the energy sector, right? And so it was, I guess, there's sort of an indirect play on certain types of inflation if you want to get cute. It seems inefficient, but
well, we're going to mention that too, that the sector breakdown of the various tranches of debt as you move through from, but you go hit it.
Oh, well, no, that's completely accurate that they do change pretty dramatically in the industry composition from rating tier to rating tier. I was going to mention with TIPS though is that we've done a lot of research. There was a piece in 2017 that we wrote because that was the 20-year anniversary of the TIPS market that analyzed their performance, and they did extremely well. They beat inflation. The problem is that so did every other asset over that 20-year period because there was no inflation.
Yeah.
But I think when you think about TIPS specifically, I mentioned this before in a comment in one of these a few weeks ago, is that if you're buying, first is the break-even rate, so the inflation expectations, and if you buy at the inopportune time and inflation does not exceed the break-even rate, then you kind of wasted your purchase. You would have been better off with nominal treasuries. At the same time, different parts of the TIPS market are correlated to different things. So the short-term TIPS market is more correlated to actual changes in published CPI. The problem is that changes in published CPI, sort of month to month, energy is a huge component of that. So like, are you really just correlated to energy versus the 30-year TIPS market, which is more correlated to actual changes in future expectations? So where you're buying at the TIPS curve, you're going to get different. I mean, it seems obvious in retrospect, right? But knowing that beforehand, it might help, at least with expectations, what you're getting out of that allocation.
It seems like you could structure some kind of explicit inflation hedge credit portfolio by collateralizing with rates or repo and layering on CDS bet and an inflation swap or something. Like if you really wanted to get cute, it just absolutely had to be in credit. It just seems like why are you using credit to hedge inflation risk, which I think is not that, I mean, if you're forced to be in credit, or like, lots of compliance departments require 40% of the portfolio for a balanced investor to be in credits or in fixed income. So it's 100% legitimate question. Does prompt the question, is that a reasonable policy in any environment?
Yeah, of course.
Certainly in this environment. But
in a portfolio context, you can expand that, and you can think about TIPS as a meaningful contributor to that. But what about the quadratic IVOL product? Do you cover that? Do you have any comments on that and how that might fit? Because that's kind of a unique and interesting, different thing.
It is, yeah. So I will. I'll have to pass on specifics. I know many of my colleagues have met with that team, but I have not, unfortunately, and we don't cover it at this time.
Okay.
So I know it's garnered a lot of attention, and like I said, we've had meetings with them, but I can't speak to it more than that. Yeah,
that's fair.
One thing I always like, the only thing I ever have really gravitated toward in credit is this fallen angels premium, right? Mm-hmm. This idea that there's a structural barrier to arbitrage for credits that lose their investment grade status, right? So they get downgraded below investment grade, and they are forced sales by insurance companies and pensions who need to maintain a portfolio above a certain credit quality. Is that still a thing? Do you still observe this fallen angels premium? And if so, are there any funds out there that target this and that you might recommend?
Sure. So it's definitely still a thing. And it's high yield managers love when this happens, for what it's worth, just because one thing that's been observed, and I think one of the reasons why fallen angels perform so well, is that you think about a company that has been downgraded, but they were IG for some period of time, right? So they have levers that they can pull that a small high yield company that's got one, like it, maybe there's no equity in the high yield company, in the IG company, they've got equity cushion and so on. They can cut the dividend. There's typically more that a fallen angel can do to either stabilize or to get back into the IG market in 1, 2, 3 years versus a triple C or single B rated company that's just so far away, right? If they want to get, even if they can get to IG, it's 10 years in the making or something. So they just have more that they can do.
That's a really good point. Yeah. I like it.
Typically bigger capital structures. It's like I said, high yield managers kind of feast whenever this happens. There are a lot of high yield managers that we would recommend in terms of that have been successful doing that. First one that a couple that come to mind would be the BlackRock High Yield Fund, the PIMCO High Yield Fund, and the Artisan High Income Fund. Three of those are different. They're different flavors, right? So, for example, the Artisan Fund, which I cover, is a very concentrated, very non-traditional high yield fund. And it's the kind that, going back to what we've talked about at the beginning, if I were to look at it at first, raises a whole lot of red flags in terms of concentration, triple C risk, and so on. But it's one of those that once you start to dig in, the construction actually works in a lot of ways to offset those risks, combined with really, really good security selection and research, versus something like the PIMCO or the BlackRock funds, which are, or the PGIM fund as well, which is gold rated. Those are all sort of more broad market, traditional high yield funds, but all of those managers will like I said, feast on fallen angels and really kind of add them in size to their portfolios and capture a lot of returns that way. GE was a big one. Sorry, yeah.
Just dovetailing on that whole concept,
Yeah.
and actually you have no idea, is it the Artisan Fund is what it's called?
That was one of them, yeah. That I
So
mentioned. Yeah.
is there an edge in credit to managers who run a reasonably sized, like I can just imagine PIMCO and BlackRock being the box in, well, at the moment, well, certainly PIMCO, the box on everything fixed income, and BlackRock being the box on everything in every asset class at the moment. Is there an advantage to managers who run a smaller portfolio, or they're able to take advantage of opportunities that the gigantic funds they may get a piece of, but it would be so small a contributor that it doesn't really matter? Is that a criteria that investors might want to consider?
Certainly, yeah. I mean, we've seen it's tricky to answer that though, or it's nuanced to answer that because Artisan is one example. Diamond Hill runs two funds as well, corporate credit and high yield, that are all in the same sort of vein where it's smaller portfolios, concentrated positions, look more like equity portfolios. And that's why I mentioned earlier, like to me, if I were to add one of these to my own portfolio, I would treat these as equity risk. But you absolutely can, because a lot of times credit coverage or credit due diligence is so time onerous for the analyst that you think about, let's say a team that is a broad market fund and they have to cover everything, and the analyst has 60 names or 50 names on their list versus a team that, let's say they've got 10 or 15 or 12 or whatever, and it's just a lot more, they can just dedicate a lot more time and they're not as rushed to cover everything coming to new issue market, like all this stuff, or sitting on too many credit committees, right? Like they're a credit analyst and a credit PM are pulled in so many different directions that anything that you can do to minimize that can be beneficial, right? Now, the other firms mentioned, PGIM, PIMCO, BlackRock, they've got so many bodies that they can do all of these things and still be good at it, right? But you need to know like what game is your manager playing, and are they good at it, right? Because you can't. You just need to fit the team.
It's the politics of portfolio management. Can they get it? Can the analyst get the idea, run up through the portfolio manager, get the approval to get the piece on the book? How flat is that management style? I mean, there's a lot of that in professional portfolio management that is an opportunity for excess return, I think.
Yes,
it's an interesting point. What about how does ESG? I wanted to come back. How does ESG play a role in the bond market, in bond portfolios?
Sure. So we recently, Morningstar recently came out with a new ESG rating, which we call the ESG commitment level, which I will touch on in a second. But to answer your question specifically, what we've seen in ESG and fixed income is the most interesting part of it, in my opinion, anyways, is the impact side of it, which is managers that are financing deals that have a very explicit ESG or impact investing goal, which could be funding public housing or water rights or solar panels and so on. And so I find it more interesting at a personal level rather than just buying, like creating an equity screen and buying stuff that scores well, right? But you're still just buying the equity, and maybe you're punishing or rewarding good or bad actors, right? But it's still just screening at the end of the day. Versus on the fixed income side, which is really the place to do it, this impact investing thing where you're targeting specific deals that have a very specific and measurable outcome, at least ideally, according to whatever ESG lines that you've laid out for yourself. Yeah.
So it's better to think about it as an expression of values than it is, trying to extract some kind of premium or as an investment objective. It's more of a values objective than an investment objective. If you think about it properly, then you can do a better job in that.
Yeah, it's interesting that there aren't that many fixed income funds that are doing this impact investing. There's only a handful. I cover 2 or 3 of them that they've actually outperformed their peers, right? There has been a performance premium from these things, but I think the reason why has been correct. Yeah. So a lot of these things that they're buying are been smaller deals that not everybody is buying, or that they've had a hand in structuring, right? Because they're also often acting as the advisors on these deals, right? So suddenly you've got a deal flow pipeline, and not everybody's buying it, and you've got a nice premium that you can collect there.
Well,
So
I think another indication of that too is in the equity space, right? If you look at governance, clearly underperforming. You look at greenness, outperforming. And so when you think about greenwashing and EVs and all of those types of things, all of a sudden, if you have an environmentally sensitive ESG, you have this outperformance. And I think we would all concede in the short term, these are just sort of random effects. They're not necessarily direct results of better ESG. Or otherwise you would conclude that governance doesn't matter and it actually underperforms to have a better governance. So you wouldn't make that conclusion, but that's interesting.
So in the category of ESG, I mean, is there general overlap when you put these different ESG funds together? Is there like a Venn diagram of like 80% of values align and then they go off on this 20% on their own? Or are we talking about the Wild West where, I'm a portfolio manager, I have certain values, I'm going to provide water through these businesses, and that gets piled in there along with 1,000 other different views on ESG? Like, what are we looking at there?
Yeah, it aligns pretty well. There's a lot of overlap, and I think a reason for that is, at least if we're sticking in the fixed income world, governance is actually not really a thing in fixed income ESG investing. Right, you don't have any ownership of whatever you're buying. A lot of times it's muni debt, for example, municipal debt, that where a lot of this growth has come from, and so you immediately cut off the governance part of it, most of it, and a lot of the social stuff as well is kind of cut at least by a third, maybe in half, just given the kind of deals and the kind of market that you're operating in. So the only thing that's left is mostly environmental, along with some social stuff. So you get stuff like the PACE loans out in California, which were loans that set above a mortgage. They were first lien to the mortgage to put the solar panels on top of a house. Then those loans were packaged and securitized and sold. They sit with the house. They don't sit with the owner, right? So a homeowner can take out these PACE loans, make their house green, and then leave and they don't have to pay for it. It's tied. There are a whole lot of, it is the Wild West in that terms, right? Going back to Adam, your comments from earlier, like new things coming out, like there's a whole lot of new stuff coming out in this part of the market that fits the ESG criteria really well. Is it going to be a good investment or not? Who knows? But it's been mostly this muni stuff along with these environmental projects that they've been financing.
So one of the things.
Go ahead, Ed.
Well, I was going to shift gears. So if you had something on this theme,
nope.
Then no.
Let's
okay.
roll.
One of the things that certainly our team is uncomfortable taking equity risk or capital structure risk in general, right? So one of the areas of credit that I've always found more fascinating is the idea of relative value arbitrage. You've got a company, you've got different securities that are backed by different parts of the capital structure, and they're all priced. And so there's the opportunity, maybe a first lien is overpriced relative to a second lien, or an unsecured, or relative to the equity tranche, or some kind of convertibles, whatever. Is that an area that you also cover? And if so, what opportunities are there? And is it an attractive area for investors to look? And what kind of criteria would you use to evaluate the effectiveness of managers in that space?
Yeah, that's a good question. Yes and no. So we do look at managers who do that. The problem is that there isn't really much. It's hard to tell who is actually doing that versus who's doing it well, and who is just saying they're doing that and kind of hiding behind a more of a macro approach, right? And the reason I lead with all those caveats is that really good fixed income managers that are operating, whether it's in dedicated corporate credit or some more multi-sector sort of core offering as well, if they are outperforming, a lot of their outperformance, and they're doing a good job of it, is going to come from being able to move between those opportunities at relatively good times. I'm not talking about market timing specifically, but relative value of one sector versus another. And then within each sector, okay, am I over or underweight securitized, for example? We'll use that. All right, now within securitized, what's attractive currently, the only thing that's left really is commercial mortgages, CMBS. All right, within CMBS, am I agency or non-agency? Am I conduit or single asset, single borrower? If I'm in one of those, am I triple B or double B, right? So for example, triple B minus CMBS risk right now, or the spread is between 450 and 500 or 550, right? Which for a triple B rated asset is right now is really attractive. But the problem with trying to find a manager who does that well is that it's really hard to identify the managers that are doing that. And then if they're doing it well, is it risk versus luck? And the reason it's just, there's no sort of flag or easy way to say if managers that are doing that explicitly and only that within capital structures. There are a couple of firms that try to do that really well. Thornburg comes to mind as one of them, with a mixed success, I think, but they're one of the ones that more explicitly takes that type of approach.
Just mathematically, it's just much harder to sort skill from luck when you don't have, when you have almost no correlation with any other benchmark. Like, the challenge with absolute return in general is that you can, especially if you've got infinite scope about what you can invest in, long or short, the noise term dominates so profoundly over intermediate horizons that it's just impossible, which is why I think many institutions like to focus on some sort of benchmark oriented evaluation. So because it's much easier, or at least you can identify skill versus luck more effectively in much shorter horizons if you're benchmarking against something that's highly correlated to your strategy relative to something that's completely uncorrelated.
Well, you think you can.
No, and totally agree, yes. And there's lots of tricks that managers play in order to pretend or have optics that they look like it and stuff.
I'm being the curmudgeon.
No, you're out curmudgeoning me, but we're on exactly the same page. I totally agree. But I love that space because, at least conceptually, and I agree, it makes it much harder to evaluate whether a manager has skill or it's just luck in a reasonable horizon. But I like it because you're definitionally removing all other sources of risk other than your ability to distinguish between different parts of the capital structure of a specific firm. So all idiosyncratic risk is removed, all market risk is removed, and it's just literally, I'm going to do this capital structure, and how much skill can I extract from that, which appeals to me conceptually.
The hard thing, I agree, and just to kind of give my 2 cents, is that the hard thing when it comes from our perspective for evaluating a firm like that is that, or a strategy, is that often those strategies, the hurdle rate that they're setting for themselves is LIBOR or LIBOR plus 30 or something,
which
like
is
that.
appropriate, totally, yes, yeah.
And it's just, but that makes it harder to,
because there's no correlation. LIBOR has no vol.
No
so therefore, there's no
analysis.
correlation, and therefore,
it's a pure return analysis, right? It's a hurdle. Doesn't work.
It's all skill.
That's the.
That's exactly right. Yeah. It's all skill plus an error term that can't be correlated to any other error term.
So therefore, it's all skill, both on the positive and negative side.
That's true. I mean, insofar as alpha is intercept plus error term, which means we have no idea to determine which is which, right? So
precisely. See, there I'm an optimist.
Nice framing. Exactly.
Well, there's a couple questions in here just to as we're over an hour, but what any thoughts on a couple of questions here on ANGL, Angel by Van Eck? Do you guys cover it? Any insights there? If you don't, it's fine.
No, I'll have to pass on that one. We and the reason why is that we split passive versus active manager research, and so that would fall under the passives team, which I do not.
But that is an explicit Fallen Angels index.
It's done really well. I follow the performance of it.
And then there's one other. Any views on CLOs and the growth of CLOs? I think we talked about that a little earlier.
That one I can speak to. That was my paper in May, or article in May, was touching on that a lot. So it's been huge, right? It's massive. At this point, CLOs are over half or roughly half of the bank loan market in total, right? So you think about bank loans are now over $1 trillion market size. Half of that issuance roughly has gone to feed the CLO machine. And if you think about that demand versus the supply that's been coming out of the private equity market in terms of issuing, that's where most of this loan issuance has come from. And if you think about the fact that within the loan sector, at this point, most loans are being issued are either covenant light, which means it's easier for issuers to, or their PE sponsors to sort of, wiggle within the deal, or they're loan only capital structures, right? So the big draw with a bank loan that we mentioned before is that they're first lien to anything below it. They're secured. You've got let's say a fixed rate bond below it, unsecured, and then the equity cushion below that, like a full capital structure. A lot of loans now that's it. It's just the loan because it's financing some PE deal. And so recovery rates have come way down relative to where they were pre-2008. And so if what you're getting out of bank loans is recovery rates that are lower than they've ever been before, they're not offering the 60 to or 80%. The average long-term average is 80%. Realized now it's closer to 60, and you are getting something that's floating rate that can be called away at any time, right? There's no call protection on these things. It's just realize I'm talking about specifically bank loans now, but it's just horribly difficult to outperform in this sector for a dedicated bank loan manager. It's just not. It's going to be really tough, that sector, and I think that flows up to the CLO market, right? Obviously, you're doing away with some of this because you're dealing with a pool of securitized loans, and like I said before, AAA CLOs have never defaulted, knock on wood. And so I think,
But they've changed.
yeah, no, it's who knows, right? I think the default rate did spike coming out of March in CLOs, and so obviously there's risk there. These things are not perfect. I think all of the underlying complaints that I have about loans obviously flows up into the pools of CLOs. And so I think you're going to get, and this doesn't even get into the economics of CLOs where you've got, let's say, second or third tier managers who are, the loans that they're putting into their CLO are all coming from their one warehouse financier, whether it's JPM or some of these banks, right? There's a relationship here between their financer and the loans they're putting into the CLOs back to the CDO.
I wonder how that gets by the board of directors.
So
anyway.
Like I said, there's a lot of strengths to that market, but we have been pretty concerned about it for about a year. Yeah.
All right, there you go. That's
That's
yes.
the detail we were looking for.
Sell them all. I don't know. There's 3 letters, ABCs. Sell them. So what are there anything, Brian, that you're working on right now that's got you super excited or terrified? Is anything in the bucket that's sort of really making your juices sort of flow that you want to share?
Yeah, I don't know if it might be freezing the juices rather than making them flow, but
yeah, that too. That's perfect.
Just the low, like we've already talked about a lot, but the low yield thing, we've been kind of beating the drum that people need to either accept that they're going to go out on the risk curve or accept lower returns to negative returns, right? If we're talking about inflation overshooting 2%, it's going to cause a lot of problems. And if you are sticking within the fixed income box, trying to answer this question, it's going to be really difficult. There's no good answer, but we're telling everybody that, or at least reminding them that there's no magic bullet for these types of things.
So do you cover preferred shares at all or anything like that? Or is it way out of your purview?
We do not. Yeah, no. Yeah, way out. Yeah. That's, I do know, offhand, that could be one approach, right? You're going to get more than in some other places. But yeah, we don't, if we cover them, but they don't, I don't.
Yeah.
Yeah.
Yep. Awesome. Anything else, gentlemen?
Did we ask about the preferred closed-end funds? Was I like distracted for 2 minutes and
we just talked about preferred funds and him not covering it, but
yeah, I had to pass on that one. Yeah.
Okay, no worries. Yeah.
Yep.
Sorry, Wojciech.
Yeah. What about him? What about the marijuana subloan industry? Like that's CBD only.
The cryptowana?
Yeah,
The
right.
cryptowana.
Crypto. It's obviously EV cryptowana.
That's right. That's the new fund we're launching, EV Cryptowana Fund.
Oh, too good, too good. Everyone's a little punch drunk on Friday. I love it.
That's right.
Any other thoughts, guys? I mean, we're over the hour. This was
Covered a lot of ground.
a great deep dive into the credit world, and so given that there's no hope anywhere to reach for yield, or anytime you reach for yield, you're going to have your whole arm cut off. Is there any parting thoughts you can offer?
For those who are forced to
more.
be in fixed income here, what segments should they be focused on right now?
Sure. I think at this point you have to look at tips. This came up a little bit earlier. I should have mentioned it before. Is that if we think about that inflation hasn't overshot yet, part of that might be just simply the fact that we're underemployed right now, like the employment rate is so low. And so if you think about if the Fed keeps rates pegged low, and then either stimulus or something happens, right, where we roar back to full employment, like like that, that could have a huge overshooting impact on inflation, or at least potentially, right? And so you've got to look at tips, I think, right now, even though the yields are not, you're not buying them purely for the yield, right? Or at least the yield right now. You're buying.
You
them for
opened the
future.
macro Pandora's box, and Mike can't contain himself. He's like,
No.
he's like
I saved
coming
it for the
over the
very end.
microphone, sticking his nose right up
I was
against
waiting for someone
camera.
to talk about employment.
Next, I'm going to bring up Kalecki, and we're all going to get in trouble. So.
Exactly.
All right.
Yeah.
All right.
Thanks,
Awesome.
guys. That was great.
Yeah. Thank you, Brian. See you Wednesday.
Guys. Yep. Have a good one.
Look, there's the banner again.
There's the banner.
God love you, Ani. This is great. All right. Thanks, guys. Have a great weekend. Thanks for tuning in. Don't forget to subscribe.
Yeah. Click like, leave a comment.
Exactly. All right.